The life insurance industry generates approximately $180 billion per year in life premiums in the United States, according to the Insurance Information Institute. A substantial portion of that revenue does not come from protecting families, it comes from selling whole life insurance policies as investment vehicles. This video is about why that is almost always a bad deal for the buyer, a lucrative deal for the agent, and what you should actually buy instead. I want to be clear up front, life insurance itself is not a scam. For the right person in the right situation, it is one of the most important financial products available. The scam is not life insurance, it is a specific type of life insurance sold using misleading comparisons and commission incentives that benefit the agent far more than the policyholder. Let me explain what whole life insurance actually is, in plain terms. Whole life insurance is a permanent life insurance policy, meaning it covers you for your entire life, not just a set term. It has two components, a death benefit that pays out when you die, and a cash value account that grows over time. The pitch goes like this: you pay your premiums, some of that money builds up as cash value, you can borrow against it, and when you die your family gets the death benefit. It sounds like insurance plus a savings account. The reality is more complicated. On a typical whole life policy, the first 1 to 3 years of premiums go almost entirely to agent commissions and administrative costs. Your cash value in year 1 is often dramatically lower than the premiums you paid. A policyholder who pays $5,000 in premiums in year 1 might have a cash value of $2,000 or less. The rest went to costs. After the commission-heavy early years, the cash value does grow, but slowly. Historically, whole life cash value grows at approximately 1% to 2% per year. Some policies from mutual insurance companies like Northwestern Mutual or Mass Mutual have performed at the higher end of that range, 3% to 4% in strong years, but the long-term average is well below 5%. Let's run the actual numbers on a typical whole life policy. Policy: $500,000 death benefit. Male, age 35, non-smoker, standard health rating. Monthly premium, approximately $400 to $500 depending on the insurer. Let's use $450 per month, $5,400 per year. Over 30 years, you pay $162,000 in premiums. The cash value on a whole life policy at that premium level, growing at 2% net, reaches approximately $175,000 to $200,000 after 30 years, again, depending on the insurer and the dividend performance of the mutual company. Now take the same $450 per month and invest it in a total stock market index fund at 10% annual return. Over 30 years, approximately $1,017,000. The difference, $800,000 or more. On the same dollars. The difference is entirely the gap between 2% whole life cash value and 10% index fund. Defenders of whole life insurance will say the cash value is guaranteed, unlike stock market returns. That is true. But over any 30-year period in U.S. stock market history, the total return has been positive. Not guaranteed, but historically reliable. Accepting a guaranteed 2% return over a 30-year horizon to avoid market volatility is one of the most expensive risk aversions in personal finance. Understanding why whole life is so aggressively marketed requires understanding how insurance agents are compensated. Term life insurance commissions, typically 30 to 50% of the first year's premium. On a $500 per year term policy, an agent earns $150 to $250 in the first year. Whole life insurance commissions, typically 70 to 100% of the first year's premium, with trail commissions of 5 to 10% for several years afterward. On a $5,400 per year whole life policy, an agent earns $3,780 to $5,400 in the first year alone. That is a 20 to 30 times larger commission for selling whole life versus term life on comparable coverage. The financial incentive for an agent to recommend whole life over term is not subtle, it is structural. This does not mean every agent who sells whole life is acting maliciously. Some genuinely believe in the product. But the incentive structure creates a powerful bias. When a salesperson earns $250 for selling you one product and $5,000 for selling you another, and both appear to solve your problem, the math of that incentive shapes recommendations far more than it should. The vast majority of financial advisors who operate as fiduciaries legally required to act in your best interest do not recommend whole life insurance as an investment vehicle. The advisors who sell it most aggressively tend to be insurance agents who are compensated on commission, not fiduciaries. Here is the honest answer to who needs life insurance. You need life insurance if other people financially depend on you. If you die in your absence would create financial hardship for specific people, a spouse, children, aging parents who rely on your income, you need life insurance. You do not need life insurance if you are single with no dependents. You do not need it if you are retired with sufficient assets. You do not need it as an investment vehicle. You do not need it to leave money to your kids if you already have sufficient retirement assets. The right question is, if I died tomorrow, who would suffer financially, and how much money would they need to maintain their lives? The standard rule of thumb is 10 to 12 times your annual gross income. If you earn $70,000 per year, you want $700,000 to $840,000 in coverage. This gives your dependents approximately 10 years of income replacement, enough time to adjust, retrain, or rebuild without financial catastrophe. Term life insurance covers you for a specified period, 10, 20, or 30 years. If you die during the term, your beneficiaries receive the death benefit. If you outlive the term, the policy expires with no payout and no cash value. That is the design, and for most people, it is exactly right. Here are real premium examples as of 2026 from major carriers like Haven Life, Banner Life, and Pacific Life. Healthy male, age 30, non-smoker, $500,000 of 20-year term life coverage costs approximately $22 to $28 per month. Healthy female, age 30, non-smoker, $500,000 of 20-year term coverage costs approximately $18 to $23 per month. By age 40, those same policies might cost $35 to $55 per month. By 50, $80 to $150 per month, depending on health status. The window of cheap term coverage is your 20s and 30s. A 30-year policy locked in at 30 years old, covering you until age 60, is one of the most efficient financial products available. By 60, if you have spent 30 years investing the difference between what term costs and what whole life would have cost, you are likely self-insured anyway. Lock it in young. Choose a reputable carrier with an AM Best rating of A or above. Set a 20 or 30-year term that covers your dependents through their financial independence. Then invest the difference. The buy term and invest the difference argument has been made since the 1970s, and the math has never been seriously refuted, only complicated by edge cases. Here is a direct comparison over 30 years. Option A, whole life policy. Premium, $450 per month. Coverage, $500,000. After 30 years, $200,000 in cash value, plus $500,000 death benefit if you die. Option B, 30-year term policy. Premium, $28 per month. Coverage, $500,000. Same death benefit during the term. Difference invested, $422 per month in an index fund at 10% annual return. After 30 years, approximately $955,000 in invested assets plus the $500,000 death benefit if you die during the term. If you are alive at year 30, Option A delivers $200,000 in cash value you can access. Option B delivers $955,000 in invested assets you can access. The difference is $755,000. If you die in year 15, both policies pay $500,000. Option B has $155,000 in invested assets at that point. Option A has maybe $80,000 in cash value. In almost every scenario, term plus investing dominates. I want to be honest about the cases where whole life does have legitimate uses. Ultra high net worth estate planning, For estates that exceed the estate tax exemption threshold, which was $13.6 million per individual in 2024, whole life inside an irrevocable life insurance trust can be a legitimate estate tax mitigation tool. This is an advanced strategy for a small percentage of the population. Business key person insurance. If a business's survival depends critically on a specific individual and the policy's permanence matters for balance sheet purposes, whole life can play a role. Specific, limited, structurally justified. Chronic health conditions. If a person's health makes them uninsurable for future term policies, locking into a permanent policy at a young age before the condition worsens has logic. These are real exceptions. They apply to a fraction of the population. For the other 95%, term life insurance is the right product. The summary is simple. Life insurance is protection, not investment. The moment someone tries to sell you an insurance product as an investment, compare it to what a low-cost index fund would do with the same money. The math will do the rest. A $25 per month term policy and $425 per month into index funds. That is the portfolio. Not a $450 per month whole life policy with a 2% internal return and a commission that paid for a salesperson's vacation. Protect your dependents. Invest the difference. Retire with assets, not a cash value account. Word count, 1 325 duration, 10-minute end card. Next video, compound interest is either building your wealth or destroying it.